For the last 40 years, gold functioned as the financial world's slow, boring, and highly predictable safety net. An investor could buy it and hold it while reliably averaging a modest 6 to 12% annual return. That baseline has vanished. Over the last 5 years, gold has shattered its own norms, averaging nearly 20% per year and consistently hitting all-time highs. At the same time, risk-on assets like artificial intelligence stocks and real estate are trading at record valuations, fueled by extreme market optimism. This breaks a historical rule of thumb. Traditionally, investors flee to gold during times of panic and move to stocks during times of confidence. They rarely buy both at this scale simultaneously. Global markets are exhibiting peak optimism, yet gold is behaving like there is a crisis. This suggests the massive cash influx driving the spike is coming from a hidden source. It is easy to assume this is a reaction to everyday consumer inflation. We see the dollar losing value when we pay for groceries or fill a gas tank. If consumer inflation were the primary driver here, the price of gold should have mirrored the massive consumer price index spike of 2021. The data shows the opposite. During the peak of the 2021 inflation crisis, gold prices stagnated. While the CPI was soaring, gold barely moved. Gold only gained momentum recently, as consumer inflation pressures began to subside. The two metrics are moving in completely different directions. Everyday inflation is a red herring for gold's current performance. The real catalyst operates outside of standard retail economics. The entities quietly absorbing the gold supply are the exact same institutions that manage the world's money: global central banks. For 80 years, foreign central banks have hoarded US dollars in their reserves to facilitate international trade and secure their own currencies. This established the dollar as the global reserve currency.
That era is shifting. Over the last 20 years, central banks have reduced their US dollar holdings from 70% of total reserves down to 58%. This 12-point drop represents trillions of dollars looking for a new, politically neutral safe haven. Central banks are filling that void by purchasing gold at a record-shattering pace of over 1,000 tons per year, double their historical average. These institutions are executing a structural pivot away from dollar reliance. They are trading the liquid convenience of the dollar for the physical security of gold. The dollar remains the dominant global currency, backed by a financial system that won't be replaced overnight. However, foreign governments are moving from a state of blind faith in that system to one of conditional trust. This is preemptive positioning. Central banks are building a hedge against long-term American debt levels and future financial risks they can no longer ignore. While retail investors focus on the optimism of the stock market, the world's largest financial players are repositioning trillions into gold. Their actions reflect a view of the future that the public markets have yet to acknowledge.